On January 1, 2025, Lessor Company entered into a lease agreement with Lessee Company for heavy equipment. The lease spans for 6 years, matching the equipment's useful life, and includes an annual rental payments of 750,000 pesos due at the beginning of each year. The lease specifies an implicit rate of 10% known to both parties and no guaranteed receivable value. The equipment shall revert back to the lessor at the end of the lease term. Additionally, Lessor Company incurred 75,000 pesos initial direct costs in the lease commencement date. This scenario requires both parties to assess the nature of the lease, apply appropriate accounting standards, and prepare the necessary journal entries and disclosures in accordance with applicable financial reporting standards. For specific requirements, we have for the lessee recognition of right of use asset and lease liability plus amortization and interest. For the lessor, we have recognition of net investment in the lease, allocation of interest income, and treatment of initial direct costs.
And with that information, let's move forward to our analysis, starting off with the nature of the lease for both the lessor and the lessee. So, the lease is actually a finance lease for both of them. The lease term is 6 years, which is the same as the equipment's useful life. Because the asset is used over its entire life by the lessee, the risks and the benefits are transferred to the lessee. Next is the accounting treatment, presentation, and disclosure. So, for the lessee, it recognizes a right of use asset and a lease liability. It recognizes depreciation on the asset and an interest expense on the liability. For the lessor, the equipment is removed from the books and recognizes a net investment in the lease. The lessor actually earns interest income over time and incurs an initial direct cost. And on the balance sheet, the lessee shows a right of use asset and a lease liability, while the lessor shows a net investment in the lease. So the disclosures include the lease term, lease payments, interest rates, and the lease classification.
C. Prepare all the necessary journal entries from the January 1, 2025 to January 1, 2027, with supporting computations in the books of Lesser Company and Lessee Company. So in Lesser's perspective, we will first get the gross investment, net investment, and unearned interest income. So for gross investment, we multiply annual rental by the lease term. So 750,000 times 6 is 4,500,000 gross investment. For net investment is we multiply annual rental by the PV factor of annuity due because the cost of equipment is not given. So 750,000 times the PV factor of annuity due is 4.790787, which is equals to 3,593,090. And for unearned interest income is to deduct the investment to the net investment. So 4,500,000 minus 3,593,090 is 906,910 unearned interest income. In the perspective of the lessor, in its journal entries, there will be a debit of equipment and a credit of cash of 75,000 because the lessor incurred 75,000 initial direct cost. Then, the lease receivable will be debited by 4,500,000, which is the gross investment. Equipment by Equipment will be credited by 3,593,090, which is the net investment, and an unearned interest income of 906,910. Uh, since there is also a payment in the beginning of the period, uh, there, there the lessor will debit cash by 750,000 and credit lease receivable by 750,000. And on December 31, 2025, debit unearned interest income of 284,309 and credit interest income just the same because there is already time passes which can be found in the amortization table. So in January 1, 2026, on January 1, debit cash and credit lease receivable by 750,000 And on December 31, unearned interest income debit and credit interest income 237,740, which can also be found in the amortization table. And on January 1, 2027, debit cash and credit lease receivable by 750,000. In lessee's perspective, you'll first get the lease liability. So annual rental multiplied by the PV factor of annuity due, which is 750,000 times 4.790787 is equals to 3,593,090, and the right of use asset is also 3,593,090. The annual depreciation is right of use asset divided by the lower of lease term and useful life. So 3,593,090 divided by 6 is 598,848, and the amortization for the lessee is the same as the lessor. And for its journal entries on January 1, 2025, debit right of use asset and credit lease liability of 3,593,090. And since there is a payment in the beginning of, of the lease term, so debit lease liability and credit cash of 750,000. And on December 31, we record depreciation and interest expense. So debit depreciation and credit accumulated depreciation of 598,848, and debit interest expense and accrued interest payable of 284,309. And on January 1, 2026, we debit lease liability 465,691, debit accrued interest payable 284,309, and credit the cash payment of 750,000. And on December 31, debit depreciation and credit annual depreciation of 598,848, debit interest expense and credit accrued interest payable of 237,740. And on January 1, 2027, debit lease liability of 512,260, debit accrued interest payable of 237,740, and credit cash 750,000.
For the recommendation, based on the analysis, the lease should be accounted for as finance lease for both the lessee and the lessor in accordance with PFRS 16. The lease term is equal to the useful life of the equipment, indicating that substantially all risks and rewards of ownership are transferred to the lessee. The lessee should recognize a right of use asset and a lease liability measured at the present value of the lease payment amounting to 3,593,090 pesos, with subsequent recognition of depreciation and interest expense. From the lessor's perspective, the lease is classified as a direct financing lease. The lessor should recognize a net investment in the lease, inclusive of initial direct costs, and recognize interest income over the lease term using the effective interest method. This treatment ensures proper measurement, faithful representation, and compliance with financial reporting standards.
In conclusion, the lease is treated as a finance lease because the 6-year term matches the equipment's useful life. This means that the lessee takes on all the risks and rewards of ownership. For the lessee, that means recording a right of use of asset and a lease liability, then recognizing depreciation and interest over time. For the lessor, the equipment comes off the books and is replaced with a net investment in the lease, including direct costs, while earning interest income each year. In short, both sides follow accounting that fairly represents the transaction and keeps them aligned with the reporting financial standards.